So, dear ladies and gentlemen, I'm glad here to be in front of you. My name is Yevhen Zaiarnyi. Thanks, Anya, for introduction, and I'm associate in FinPoint. FinPoint is an independent financial advisory boutique. So basically, just to give you the idea of what my professional occupation is, we advise our clients on M&A. We provide to our clients M&A advisory, debt restructuring services, as well as advise them on different corporate finance matters. That's why my today's topic is related to M&A deals, and my today's idea is to give you a grasp on my today's idea is to give you some sort of flavor on how sell-side M&A process looks like, and where valuation exercise actually take place in the process, and what techniques are actually applied in real-world situation. So I just realized that I don't have math at all in my presentation. I don't know whether it's good or bad. I'm pretty sure you're already tired, and just because of so really brilliant speakers today, like you already know the basics. That's why I'll guide you mostly through the process, and what some sort of different valuation methods are applied on both sides of the transaction. So like each M&A process starts with the motive. So a motive is simply a core of each M&A transaction. Some M&A transaction happen just because private individuals are really bored to run their business for more than 10 years. For another group of private individuals, the matter of selling their business is mostly related to estate planning purposes. So they just want to transfer the more liquid assets to the next generation, and not to bother them with having some, for example, heavy machinery business or something like that. So yeah, in terms of strategic players, it might be the case that a newly adopted strategy by a board of some international strategic player may simply stipulate that the company should concentrate on some specific regions or countries, and facilitate the smooth exit from other geographies, and that could be also a motive for the M&A transaction to happen. Yes, some different motives are related to financial players, and those you probably know that the key thing for them is just making the return for their LPs. And the thing that I decided, the reason why I decided to start with a motive is simply because understanding a motive throughout the process will definitely help you to leverage your bargaining power in negotiations, which I'll elaborate on a bit further. So a typical M&A process takes like five phases. It's pretty simplified, but in order to somehow show it on one slide, I just divided it into 5 phases. And looking into more detail into the first phase, what happens here is that sellers of the business have realized, have identified, realized, and clearly understand all the value drivers and all the growth factors their business contain. Why is that important? And it's simply because from the beginning of the process, they need to build a solid and comprehensive equity story, which will be further proposed to potential buyers at further stages of the process. So sellers of the business usually engage here financial advisors. Financial advisors are either investment banks or some corporate finance teams, wherever, who will facilitate, who will help their clients and sellers in this respect, facilitate the process, do all the preparations. so that the investment opportunity is presented at marketing stage, at the second stage, in a colored and solid fashion. Here, all the at this stage, all the preparatory work is done. All the marketing materials are prepared by financial advisors, and the key thing here is sellers at this stage, at the very beginning of the process, have to understand and have a little bit, not a little bit, but clearly understand where their price expectations of potential price and value of the business are. And here the first round of valuation really happens. So at the end of the first phase, what the sellers have is a long list of potential buyers, which is prepared and provided to by financial advisors, marketing material, business plan. So they have already equity story prepared, and they do their initial price like calculation. And how is it? How sellers actually do approach valuation exercise? And the idea is pretty simple. I am pretty sure that you heard of you heard of all these valuation techniques throughout the day to day, and you know probably all of them. And some of them are pretty common in terms of their applications. Some of them are more rare, but still. So most commonly used valuation methods are firstly Dcf valuation, comparable companies, comparable transactions. That's what you hear through like everywhere. But the idea for valuation method is the key thing is to in applying specific valuation method on seller side is understanding what the results and the implications of the output of valuation exercise actually mean. Because what I mean is that with each valuation method, the result will be different, and different not just in terms of different figures, just because even one method applied in two consecutive days will give you different value figures, but still they are different in terms of explanation and the type of value that you receive in the as an output. Just for example, if the sellers do their DCF valuation, like what they receive as an output is mostly is reflected by so-called fair market value based on seller's set of assumptions. So they value the company as a standalone business which is owned by the sellers, and they and it pretty much reflects the fair market value. But what is fair market value? Fair market value is clearly the value that is the value of the asset that the willing buyer and the willing seller, with each one being not under compulsion, can come to the agreement to transact at. So all the buyers, sellers are hypothetical. But what M&A transaction stipulates is simply that each potential buyer will value the asset differently. And why it happens? Simply because there are some additional components that they include into their value estimates. So in terms of comparable companies, comparable transactions, what is they are the second most widely used group of valuation techniques, but the question is whether they are correct in terms of their value explanation. And my idea is simply that applying some particular valuation technique, you should understand what's behind. Just because comparable, just because you can easily divide all the techniques so that they are viewed either from seller's perspective or from buyer's perspective. So, and I want to highlight some pretty common pitfalls that analysts meet throughout their work. First of all, for comparable public companies valuation. The first thing is that for a company to be really comparable to the company being valued, it should have the same growth potential, the same risk in terms of the same risk and the same cash flows. If we translate it somehow into real-world criteria, what like most academics say that the comparable companies should be the one which has the same industry, the same geography, is the same in terms of size, in terms of profitability, growth rate, and what else, and capital structure, by the way. And for those who did comparable valuation in their job or like in their profession on a daily, who does on a daily basis, have you met many such companies that really meet all the above criteria? So it's really hard to, especially for emerging market country, I believe, like Ukraine, hard true group of comparable companies outside Ukraine, simply because the situation is completely different for each industry, for each country, just because the regulation in one country may never be applied in another. However, it may influence profitability, it may influence growth profile and further drivers. Then the second pitfall that I believe the outcome of this is that you definitely if you see that, for example, from your initial search of comparable companies, most of those or like some of those don't meet the initial criteria that you set for the selection of companies, try to explain based on these factors whether you can explain why that or this company cannot be included or excluded into analysis. And a true comparable would be the one which meets all the criteria. In terms of the second widely happening pitfall is probably that analysts simply download their multiples from the multiples for comparable companies from analytical platforms like Bloomberg, like FactSet, like Capital IQ, but and they don't really look into what is behind those multiples, and especially in concerns forward-looking multiples. So you should, as an analyst, you should, and as a person who does valuation, you should understand how those financial metrics of comparable companies were adjusted, because sometimes it happens when really non-recurring items occur in some particular years. They are adjusted by analysts in their, for example, projected or historical multiples, but you really don't know whether you should do that particular adjustment on your own when applying that multiple. And secondly, and thirdly, don't overlook control premium. So as I mentioned before, the key thing when applying certain valuation method is to know where it will lead you. So, and like comparable companies is not about acquiring the whole company. It's really a value for very minority shareholders. But the situation is that the control may simply change and enhance the corporate rights of certain investor to a very material extent. The case that I probably think most of you are aware in Ukraine is Ukernafta. So basically the situation was somewhat comparable where really it was explicitly shown how the corporate rights may change the strategy of the company and management and all the other stuff. Then comparable transactions. The comparable transactions should be really comparable as well as comparable companies. My recommendation for this is that each analyst should set a specific set of criteria and not deviate from it. Just because when somebody sets a criteria and after that he or she doesn't find any specifically comparable companies, they just try to extend the criteria and include more and more companies into the peer group, so they can somehow explain and like support their valuation output by the number of companies. So that shouldn't happen at all, I believe, just because, again, geography. Why picking up companies from different geographies is not companies but transactions from different geographies is pretty misleading exercise. For example, take Ukraine. In Ukraine, take Ukraine in terms of and compare it with some other emerging market countries. What we had for a couple of years is strict capital controls. What does it mean? Just because the outside investor really could invest the company in the country, but couldn't extract the value of their investment back for several years. Do you really believe that in such circumstances, for example, the transaction in some other country would be valued at the same multiple? I don't believe so. That's why when applying, the ideal world is when you apply specific, when you find specific transaction, you should really get some assurance that there are no some regulatory issues or some other country-specific issues that will like mislead your valuation results. And again, in terms of transactions, the next pitfall is when, for example, analysts choose too extended time frame for their analysis. And why is that important? Simply because of economic cycles. Just the company valued at the bottom of the economic cycle and the company valued at the peak of the economic cycles will be valued at completely different multiples. And if you, for example, look, unfortunately, I don't have that graph in my presentation, but you can look at a historical, some sort of average multiples throughout like the whole world or just by regions, and you will see that the multiples like increase from year to year, but to the extent they are supported by economic growth. And finally, valuation of a minority or a majority stake in the company should also be considered by analysts, simply because if you just do your search and apply all the relevant, all the multiples that you found, what you can easily miss is the control premium, the premium which investors pay for to approve on their own specific important corporate decisions. And now switching to DCF valuation. So it's pretty common and everybody knows how to build DCF models, but the why I believe DCF model is really important in terms of seller's perspective is that it can give the opportunity to see what the model and the business is really sensitive to. That's why even if nobody believes in the assumptions, I think that DCF model should be built just because the sellers will see what particular variables is their business very sensitive to, and what variables might be negotiated between sellers and buyers further in the process, because it might be really a negotiation point when the seller believes that his or her business will achieve particular results, but the buyer doesn't support this idea. Then when building DCF models, the problem for some companies is When they build DCF models, they do it. They might do it internally, and when they do it internally, the work is done by investment of financial professionals. And the negative point here is that sometimes those professionals don't support and consult all the company's management, all the technical professionals in the field, just to support, just to corroborate each and every variable which serves an assumption for the years ahead. And that's very important, just because what we had recently in one of our projects is, for example, when the model, there was an internal model of the business built by a chief investment officer, but when we, and we as investment advisory firm, when we came in, we didn't trust those assumptions. And when we approached technical staff in the company, they confirmed that such indicators couldn't be sustainable or in the long-term perspective. Then cost of capital. So it's pretty, it can be really easy to calculate cost of capital, but you can do a really massive job as well. So massive work as well. Many buyers or sellers, they don't calculate cost of capital with CAPM models. Why it happens? Simply because it's too complicated. And especially to explain to some shareholders, because in private businesses, whatever value management receives, he should show it to the shareholders and to explain them why their business costs not like $200 million, but rather 20. So, and that's why what they do, like shareholders ask all the detailed questions, how did you achieve that? And you should really be not academic in this respect, but rather choose a real world approach. In the companies that I know many strategic players on the market who firstly calculate equity, cost of equity and cost of capital with a build-up method, and it's commonly used throughout industry, simply because even in Ukraine we don't have so much comparable companies in Ukraine, so we face some cross-border differences that might have some impact on valuation as well. That's why many investors and many sellers just choose a build-up method. And what I recommend is find equity research for the companies in your particular area of business, and just to compare all the, if the equity analysts apply Dcf valuation, just to for you to see what is their cost of capital there. Just sometimes it happens that you are that people not familiar with the investment field and who calculate just recalculate cost of equity once a year, they simply get unrealistic figures and they don't know about that those are completely unrealistic. That's why I recommend to benchmark those against comparable companies, and specifically for the country where the company being valued is situated. And of course, tax aspects. What I mean under tax aspects is, first of all, effective or marginal tax rates. Of course, academic valuation tells you apply marginal tax rates, but good. But if your company had undergone a massive some investment program, or like has just completed construction of a new plant, it has a significant VAT asset which might be often overlooked. And another point which many miss is the timing of VAT settlement or VAT reimbursement. Specifically, if you build the DCF model on a yearly basis, you will never encounter those. But if you build your model on a monthly basis, you will see that corporate income tax is paid in 1 month, VAT is paid into VAT is reimbursed into in a different month, and there is actually a settlement for a particular time period, and though all those factors do really matter in terms of the impact on valuation. So after that, when sellers came up with their initial price expectations, when they have some figure in mind what their business, what they would be ready to sell their business for, the work of investment and financial advisors starts here. So the financial advisors distribute approach investors with presenting them the opportunity to invest into particular company, so like 100% acquisition of some company, so they sign non-disclosure, they send a brief overview of the company, so-called a brief presentation with a brief overview of the company, so-called teaser. After that, they sign NDAs, non-disclosure agreements with some interested parties, and they distribute more sophisticated and more comprehensive materials about the company. So that is represented by either investment memorandum or information memorandum or info pack or some other marketing materials. It might be the case that financial model is prepared at the first phase, and after that, when investment and financial advisors do their marketing job, they distribute financial models that reflect sellers' expectations, so that there is some clear guidance and point to discussion with potential buyers. And so what we have here is usually a set of calls, Q&As with some interested parties, and all this job is done just for the buyers to understand the initial and to form the initial price expectations as well. The amount of information is limited to some extent that is provided to buyers. That's why they cannot do their complete and final offer, but simply first offer. In the meantime, in order for the process to run smoothly, sellers do their data preparatory work. What that means? They simply collect all the data, all the information internally that will be further presented at the next stage and provided to the buyer. And it's really heavy job just because you need to involve all the different departments and understand what the buyers will want to see and to check at the due diligence phase. So, and comparative process stage start probably with the first step in this process is indicative valuation on buyer's side. It's where buyers come up with their estimate the price of the business for the first time based on the information that was provided to them on a previous stage, and they express their price expectations in a document or so-called non-binding. They make so-called non-binding offer to potential to sellers, and sellers see whether they want to proceed with those buyers further in the process. After that, the virtual data room, or simply VDR, is prepared by sellers themselves or by his or her financial advisors, and the ultimate step here is the refined valuation exercise. And after the due diligence procedure, sellers possess, or the buyers possess, all the relevant and significantly significant set of information, so that they come up with their final price proposal, which will be reflected in the binding offer. And starting from the initial phase, from the initial step, when buyers need to come up with the indicative price guidance so that they can make some sort of indicative price proposal. What they need to understand how they approach valuation and how buyers usually do that exercise. So they, as I mentioned before, they have some additional components incorporated into their price estimation. And what is that is simply they value the initially from the beginning of the phase, they can value the business as a standalone business, just because they don't have so much information available. So given that the amount of information is pretty limited, they often use a market approach to provide sellers with indicative price guidance. But after that, once they reach due diligence phase and they thoroughly analyze the company from different perspectives, what they can come up with is some additional premiums or discounts that they expect they will realize once the company is integrated into their business. And what I'm talking to is synergies. Synergies is pretty common. Everybody knows that synergies is a key term of key reason of many transactions to happen. But in many transactions, those simply fail to be realized. And additionally, buyers also incorporate some discounts based on their expectations not matching the ones of the sellers, and there might be also risks that the buyers are not ready to incur. So in order to do a thorough investigation of the business and understand all the risk factors that could put under risk the valuation exercise of the buyers do their due diligence of the business, and in order to do a profound due diligence, you need to study a vast majority of different areas the business is involved in. And that's basically buyers study the legal side of the business. In terms of legal due diligence, they study financial side of the business, and particularly the tax side, so that they can get their be sure that there are no massive risks in each of those mentioned fields. So, but besides commonly used and commonly done legal and financial due diligences, there are also operational, regulatory, commercial, technical. So some of the buyers do really comprehensive and profound job while studying the target, and so. And it's critically important to, this phase is critically important just because it will further translate into adjustments to buyers' price that it will propose. What I mean under synergies, and another side of those, of that notion, of that term is hidden costs, just because everybody tells about synergies, but nobody touches hidden costs. Those can be incurred in four main areas: simply enhancement of revenues, then reduction of costs, and increasing the efficiency of internal processes. And the financial sides, for example, the seller, the buyer can refinance target debt at a lower rate once they acquire it, and it will definitely be a synergetic effect. On the other hand, when a transaction happens, for example, some of the suppliers or customers of the sellers may simply terminate their cooperation just because they're afraid of massive bargaining power over combined businesses, or some in terms of hidden costs. The business may also incur some cost of installation of new IT systems and new hiring new personnel and so on. Understanding all these synergetic effects is paramount for strategic players, simply because all of those are further reflected in the financial model of a combined business. So, and how do buyers actually value the synergies? So there is pretty easy formula. The value of synergies and hidden cost in the business is the value of a combined business based on a combined on a financial model of a combined business minus some of the values of the separate businesses, and that's the value of the synergies or of hidden costs. It might be even negative, that will be added to the indicative to the first term indicative valuation that was done at the beginning. So other components of buyer's valuation are also different, as I mentioned, different expectations and their set of risks that specific buyers are not ready to incur. For example, like technical assumptions in the model, or technical assumptions that are provided by the sellers might not match buyers' expectations, and that's a critical point. Just because the buyers don't really care about what sellers incorporate into their models, they do their own adjustments, they do their own assumptions, they build their own models, and what this term is about is specific adjustments based on assumptions that really differ between buyers and sellers. For example, the company may have either excessive working capital based on buyers' estimates, or like lacking working capital, and the buyer will do their own adjustment in terms of whether they can release some cash from the newly acquired business, or that they need to further invest into working capital of a new business. So, and risks. There are the idea of risks that the buyer is not ready to incur simply translates into like, actually the formulation is that the buyers are ready to incur, but that is translated into adjustments of a discount rate, or into adjusted cash flows. For example, increased macroeconomic or political instability. When there was a case with introduction of martial law in Ukraine, so we had some processes that the buyers simply told that we are not ready to proceed with such such discount factors, just because what we expect, what our expectations were revised, just because now the macroeconomic risks have gone up. So the same with regulatory side. For example, when there is when a policy of a regulator in some particular field is not clearly defined, it might be the case that the buyer wants to make specific adjustments to the discount rate in order for those risks to somehow reflect those risks in their value estimation. And there are also company specific factors. When, for example, buyers do their due diligence, legal due diligence, and they realize that there are ongoing litigation processes with the company, so they will never, or it might be the case that they will adjust again their risk expectations, and as a result, the discount rate in their model, or like for example, as you assume some cash outflow from the business at some point, and adjust cash flows in the model. So, and after that comes final negotiation and signing phase. The idea of this phase is that sellers, after receiving binding offers, have close negotiations with only a few of them, and they start negotiation not only the price, because the price was reflected in the binding, so-called binding offer or final price proposal the buyers did on the previous stage, but they start discussing the particular terms of the transaction or transaction structure. So it might be the case that the pre-signing business reorganization or restructuring can be needed. It might be the case that the final outcome of this phase is that buyers and sellers sign their sale and purchase agreement, and then antitrust filing is done. But that's certainly not the end of the process, simply because the price is not the only factor that reflects the attractiveness of a particular transaction for some buyers and for the sellers. At the heart of each M&A transactions, there is a decision whether the sellers they divest or sell the assets of in their business or the shares of their business. Whether the method of payment. For example, it might be the case that some buyer proposed a higher price, but he proposed to pay like 30% of that price in the issuing their own debt, or he could propose like paying a higher price with some percentage of the price being paid in shares of the buyer. So all these factors and that's why method of payment is really important for the seller to understand whether he will get the cash or some other method of payment, and that is usually stipulated in binding offer. So the buyers propose not only specific price, but rather the specific transaction structure that will be further materialized in the SPA. Again, degree of price conditionality. It might be the case that the transaction will happen at fixed price or at conditional price. For example, if there is certain conditions in the sale and purchase agreement saying that once the business achieves specific financial metric, there will be higher price assigned to that business, and the sellers will achieve, like for example, higher multiple. Number of steps in the transaction. The transaction might be conditional upon receiving of specific financing, just because the buyer might see a lot of value into this in this particular acquisition, but they might not have so much cash on hand. That's why what they do is they do their offer, but what they indicate in the offer is that the transaction is conditional upon receiving of financing for the deal to happen. And again, escrow, how much is usually retained on the escrow account for the buyers, for the sellers to to somehow for the buyer to have some sort of surety that the business will not go down completely after the sale is done. And of course, options. So some transactions may be structured in such way that either buyers or sellers have put or calls options that could be exercised further on. And the variety of probably the number of transactions transaction structures is as high as there are many like imaginative or many creative M&A legal and financial advisors, because that's basically their work to not only to value the business and to arrange the process, but to structure transactions and provide advice in terms of what structure of the transaction will meet both buyers and sellers expectations. And again, what we have in a scenario where buyers and sellers value their businesses differently is a valuation gap. Just because, for example, when the buyer applies one method, the seller applies another one, so there is some 15-20% gap or like 10% gap that the parties cannot really breach. And there are some specific methods that are really hard to value and to show the direct economic effect in terms of one figure, but which might be a good solution for the breach to bridge that valuation gap. First of all, as I said, it's contingent payments. The payment of specific, for example, in a staged transaction, payments of specific sums may be contingent upon some milestones in the business reorganization. So, for example, when some company transfers all their contracts to another entity, some part of the final price consideration is released. When sellers achieve another corporate milestone, the more price is released. Or, for example, it might be the case that the sellers would, or the buyers would insist so that sellers remain invested into the business. What I mean by that is that they retain an equity share in the business and remain motivated into further business development. And in such case, the buyers would be able to propose a little bit higher price, since because they have some sort of assurance that if the business goes wrong, the sellers will incur those losses as well. Then share consideration. So again, share consideration, promissory note from the buyer, or some consulting agreements are all additional ways to structure transaction so that the seller could accept the offer with a price that is a little bit lower from what they expected initially. And what we have finally is the closing of the transaction. Regulatory key milestones at this phase are firstly receipt of all the regulatory approvals after the signing of a SPA by the buyers or by the sellers, then fulfillment of all the condition precedents in the transaction. For example, some for final business restructuring, that could be also a component of the SPA, and final due diligence. What I mean by final due diligence is it is related to final price adjustment. And what is final price adjustment is just there are two commonly used methods. Firstly, and why it happens, because the parties sign a SPA at one date, and the consideration is paid into another date. And the transferring of economic risks between the dates is really what the parties need to negotiate additionally. And for example, two commonly used methods are mechanisms that are used for final price adjustments, which is paid at the closing date, are locked box and completion accounts. With a locked box, for example, the companies, buyers and sellers agree on some determined specific price, and that price is determined based on financial statements prepared for some particular date. And after that, so the company is like a locked box. So the value cannot be extracted from the company in any way. So there is a specific term leakage, which is specified. It could be either payment of dividends, it could be payment of interest on shareholder loans, or whatever it could be. It is specified in this sale and purchase agreement, and the sellers cannot extract any value after the locked box date. And after at closing date, the fixed price agreed at the locked box date is usually adjusted for the leakage if some like value extraction actually occurred. And with completion accounts, so again the price is the price is calculated based on completion accounts date, based on the last set of available financial accounts in the company, and the buyer pays then the parties sign SPA, and buyer pays purchase price based on completion accounts. But after that, after the closing of the transaction, when there are some when the financial statements for the closing date are already released and are available, there are specific price adjustments to the price consideration that was paid at the closing date to the seller. So it might be the case that the sellers will need either to return some of the payment that was done to them, or it might be also the case that the payer or that the sellers will receive additional payment. So the common price adjustments which happen here are either debt-free, cash-free basis. So basically, the equity consideration is adjusted for the net debt, and for the change in net debt, and net working capital. Net working capital is recalculated on both those dates, and depending on the difference in net working capital, the adjustments are made. So, and the last thing that I want to highlight is probably the easiest in terms of slide, but the most, I would say, important for the owners of private businesses, how to maximize the value and ultimately the price of the private business in the M&A transaction. So, first of all, the sellers, when starting the process, they definitely need to prepare a solid and as a solid business case, which they present to the buyers. What I mean by the business case is that they need to show the opportunities to grow the business. It is definitely desirable to have a business which have different growth factors, but not the only one. To present business that has diverse product portfolio, product or service portfolio, that has growth potential in terms of geographic footprint, that has growth potential in terms of approaching new client base, and so on. So sellers should really spend their time to prepare to all those questions and how their business should be presented to potential buyers. Then several years of audited accounts really matter. Why is that? Just because the buyer will get some additional assurance in terms of the financials, that there is no fraud in the financials. Again, buyers would appreciate experience and effective management team and corporate governance system, and particularly important. But that point is particularly important for financial investors, simply because they need to trust the management of the newly acquired business, just because they might not have such a profound expertise, and that's why they will trust expertise of the management team. That's why having management with years of experience in the strategic multinational company would definitely enhance the value proposition for the buyer. Then pretty sound point is cooperation with internationally recognized counterparties or financing providers, working with EBRD, working with IFC, working with some development finance institutions will definitely mean that the company has done all the compliance check properly, and as a result, it can be trusted and regarded more seriously by potential buyers. International business orientation in a country where economic risks are pretty high and there are risks of devaluation showing to potential investors the opportunity that the business might grow not only in Ukraine but overseas, and that you have clearly defined strategy for that growth would translate into, I believe, into higher value proposition. And the last point is VDD. It's vendor due diligence. So it's the due diligence report. This exercise is done on the seller side, and with vendor due diligence, the seller will either identify specific risks that they can mitigate prior to starting the sale process, or they can easily provide VDD reports to the buyers showing that the business has really limited risks in different areas. And that's probably all. Thank you for your attention.